What if you could learn directly from Warren Buffett before he became a global icon? In 1979, he wrote a shareholder letter packed with timeless wisdom. This video breaks down 15 core lessons, plus a bonus insight, so clearly that you'll walk away thinking like an investor, not just a speculator. Lesson 1. Focus on return on equity, not earnings per share. Buffett warns investors, earnings per share can be misleading. It often rises just because capital is reinvested, even if poorly. Instead, look at return on equity, ROE. How effectively management turns your money into profits. It reflects the true strength of the business model and leadership. Takeaway from Lesson 1. Judge management by how they grow your equity, not just EPS. Lesson 2. Inflation destroys real returns. Buffett notes, despite 20% annual growth for 15 years, Berkshire's purchasing power didn't increase. Why? Inflation and taxes silently consumed real gains. This combo is what Buffett calls the investor's misery index. Takeaway from Lesson 2. Always measure success in purchasing power, not just reported gains. Lesson 3. Buy great businesses at fair prices, not bargains. Buffett made a mistake buying a struggling textile mill because it was cheap. But cheap doesn't fix bad economics. He realized a great business at a fair price beats a bad one at a bargain. Takeaway from Lesson 3. Price matters, but quality matters more. Lesson 4. Underwriting discipline is everything. A Berkshire insurance manager slashed volume but made huge profits. Why? He only wrote policies with favorable economics. Buffett celebrated this discipline, rare in an industry obsessed with growth. Takeaway from Lesson 4. Only write business when the math makes sense. Lesson 5. Avoid long-term bonds during inflation. Buying 30 to 40-year bonds in an inflationary world? Buffett called them obsolete. Why lend long when money is eroding quickly? Even insurers shortened their policies but bought long bonds. Irony at its best. Don't lend long when inflation is high. Takeaway from Lesson 5. Don't lend long when inflation is high. Lesson 6. Retained earnings create hidden wealth. Companies that don't pay dividends aren't necessarily bad. If they retain and reinvest capital effectively, they silently grow your wealth. Buffett called this the invisible engine of compounding. Takeaway from Lesson 6. Smart reinvestment is more powerful than payouts. Lesson 7. Turnarounds rarely turn. Buffett learned this painfully. Buying troubled businesses in hope of a fix almost never works. Better to buy strong businesses that don't need fixing. Takeaway from Lesson 7. Hope is not a strategy. Avoid value traps. Lesson 8. Avoid financial engineering. Berkshire didn't use gimmicks like excessive debt or earnings smoothing. True value came from real business performance, not manipulation. Takeaway from Lesson 8. Substance over style. Watch for real profits. Lesson 9. Think in real, not nominal terms. A 20% return sounds amazing, until inflation is 15% and taxes take another 5%. Buffett reminds us, the real return is what matters, not what's on paper. Takeaway from Lesson 9, real returns =, what your money can actually buy. Lesson 10, align with long-term shareholders. Buffett didn't want traders. He wanted partners, investors who understood the long game. That alignment made his strategy easier and performance more sustainable. Takeaway from Lesson 10. The right investors are as important as the right assets. Lesson 11. Communicate with candor and simplicity. Buffett wrote all his letters himself, plain, honest, and clear. No buzzwords, no PR, just the truth. Because shareholders deserve facts, not fluff. Takeaway from Lesson 11. Trust leaders who speak plainly, not those who spin. Lesson 12. Insurance magnifies human judgment. Insurance amplifies human decision-making. Good judgment creates massive gains. Poor judgment causes collapse. Buffett only trusted leaders who understood risk deeply. Takeaway from Lesson 12. In judgment-based businesses, the people matter more than the math. Lesson 13. Incentives drive decisions. Buffett saw insurers hiding bond losses because accounting allowed it. The result? They held bad assets far too long. Incentives, not logic, explained their choices. Takeaway from Lesson 13. In business, always ask, who benefits? Lesson 14. Decentralize operations, centralize capital. Buffett let his businesses operate independently. but capital decisions always made from HQ. This balance drove speed, trust, and discipline. Takeaway from Lesson 14. Let great operators operate, but centralize money decisions. Lesson 15. Expect cycles, don't time them. Buffett expected 1980 to underperform, and he did nothing. Why? His businesses were still great. He didn't try to time the market, he built to survive any cycle. Takeaway from Lesson 15. You don't need to predict the storm, just sail through it. Bonus lesson. Book value, intrinsic value, that is, book value is just an accounting figure. Buffett says, focus on cash flows, business quality, and earning power. That's where true value lies, not just the balance sheet. Takeaway from bonus lesson. Accounting economics. Learn to see through the numbers. Every lesson in Buffett's 1979 letter still applies today. Why? Because investing truth doesn't age. Think long-term. Avoid illusions. Focus on value. And like Buffett, you'll build something lasting. If you found value in this breakdown of Buffett's 1979 letter, imagine what's coming next. Hit subscribe, like, and drop a comment with your favorite lesson. Thank you.